David, I'll start with you. We've got the move itself. We've got the press conference. What in the statement will you be watching?
Well, first of all, they're going to have to acknowledge that there actually has been a slowdown in both consumption and production, because industrial production fell for the last 3 months and real consumer spending fell for the last 2 months. So they'll have to acknowledge that right off the bat. And that's the first sentence of the statement. The thing I'm going to be watching is, are they going to change the language about future increases? Can they say, well, there may be some further tightening in the federal funds range or something like that? Because they've got to get, I think they need to back out of the idea that they're locking in 2 more rate increases after today. We get 25 basis points today. I think that's unwise, but I think it'd be even more unwise to do another 2 rate hikes in March and May.
Cameron, I know that all three of you basically agree that a quarter point is baked into the cake here, but I want to pick up on something David just said. When is this all going to end, Cameron? When are they really going to stop this rate increases? Is it this meeting? Is it next? Is it May? When?
Well, if we believe what the Fed says, it would look like May, because the Fed has given guidance that they want to see rates above 5%, which would imply another hike in May. And I really think it's the question of how much they want to push back against the rate cut bets in the back half of this year, because we still have about 50 basis points baked in for the back half. I think that's the real question mark for markets, is that pushback against cuts.
Jim?
Look, I mean, the Fed has a very difficult job today. In one sense, they have to decide that they're slowing the pace of rate hikes to 25 basis points. On the other hand, they don't want to let people think that the terminal rate is already baked into the cake and that they need to keep that an open, hotly debated question that they're thinking about. That way they introduce two-sided risk into the markets. So look, I think they go 25 today. They probably do another 25 in March. That will, in my view, that's probably where they end the cycle. But overall, the key message for them that they're going to have to communicate is how wage inflation and the tightness in the labor market are really key factors that they're keeping an eye on, because the worst thing that can happen to them is have inflation not come down enough, become unanchored and start to rise, and then they have to restart their hiking cycle.
So, David,
they've got to skirt that line.
David, you said something very interesting. The Fed would be wise to call a halt to rate increases right now. Why?
Because this, the economy is like a big cruise ship, and when you're bringing it into port, you're supposed to cut the engines and just drift in. Instead, they're sort of revving up and heading for the pier here. It makes no sense to over-tighten and then actually project that they're going to have to cut rates in both 2024 and 2025. That's what they're saying right now. And there's nothing in economic theory which says the right way to stabilize the economy is to overshoot in interest rates and then cut. So I think they're playing with fire here. We could end up with a recession in the second half of this year, an absolutely unnecessary recession because they over-tightened.
Do you agree with that, Cameron?
Not necessarily, because we think that we're starting to see some early signs that maybe the deceleration we saw in inflation in the back half of 22 could actually start to abate, meaning inflation could reaccelerate, mostly because of energy prices, which are starting to climb again. And because we've seen so much resilience within the labor market, look at that JOLTS number today, we don't think it really gives the Fed much wiggle room in order to become accommodative, because the Fed is very afraid of inflation coming back, which means that they've continued to say there are greater risks of under-tightening versus over-tightening.
What are your kind of knee-jerk reactions here? What jumps out to you?
Yeah, so look, I think that another hike in March is probably on order. I think it's going to be very important to hear what they say in the press conference, in the sense that wage inflation, the tightness in the labor market, I think is what's concerning them the most. It's service sector inflation, and one of the biggest feed-ins to higher prices and wages, obviously, clearly is the tightness in the labor market. So this needs to be addressed. And I think the way the Fed is reading this is they're saying that, look, the terminal rate is not a done deal yet. We're still going to debate whether it's 5 or even 5.25%. And what they're trying to avoid is a type 2 error where they don't do enough right now when they've got inflation on the run, and then all of a sudden inflation starts to resurge again later this year, and then they have to restart their cycle, and that hurts markets more.
I'm going to go to Bob now, and then I'm going to come back to you, David Kelly, and remind David of something he said that has stuck in my head since before this rate tightening cycle began. But Bob, we were at 300 points down on the Dow as we headed into this result. Right now we are down 367.